investor friends, I'm Michelle Markey, and today I'm going to talk about the top 10 signs that the US economy is heading for a recession. And this is stemming from the fact that the Federal Reserve has had to raise interest rates, or also known as the Fed funds rate, in order to combat some of the highest inflation we've seen in 40 years. And a byproduct of this is slowing economic growth, which means that there are clear signs that the American economy is weakening. And some of this is really weird because there's still plenty of jobs to be had. Like in June, there was a gain of 372,000 jobs. And while consumer spending had been strong, there's also signs that this is slowing down. And that's a big deal because consumer spending makes up 70% of US GDP, which the last I checked was at $24.4 trillion. So it's kind of a big deal when American consumers don't feel like spending money. And so I'll share what I've learned from the Wall Street Journal and the New York Times based on some of these top 10 signs that I've put together. And if you appreciate learning about economics and being prepared no matter what happens, I hope you'll like and subscribe to my video and YouTube channel because I really hope that this stuff will help you be prepared. So thanks. And if you've watched any of my videos before, you probably know that sometimes I talk about macroeconomic and recession signs because I find this topic to be super fascinating, and I personally like being prepared so that I'm not blindsided by the slow-moving train wreck that is a potential recession underway, perhaps. And in one of my recent videos, I talked about how the Federal Reserve and economists are basically predicting a recession for early 2023 based on the Fed's projections for unemployment rates, inflation, and their Fed funds rate. And aside from high inflation lately, it looks like economic conditions were as good as they were going to get because unemployment has hit pretty low rates of only 3.6% as of June 2022. And it's probably going to go up from here as economic conditions worsen based on the following signs I'm going to talk about. And while inflation isn't necessarily causal of a recession, it is highly linked with a bunch of factors that have downstream effects on overall health of the economy. So I'm going to talk about the following signs in order of the lowest market value size to the highest market value size, because presumably the factors that have the biggest market value probably have the biggest effect on the economy. So I hope some of these signs make sense to you too. And starting with sign number 10 in the commodity copper, this has a global market size of over $200 billion. And this commodity reflects sentiment about the global economy because of its widespread use in cars, manufactured products, buildings, and more. And the fact that it's hit a 17-month low price as of July 1st is concerning because it's now down by about 30% from its March 2022 price figure. So this is a potential recession sign. And in sign number 9, with about $330 billion invested into startups in 2021, it looks like both the amount of investment and also the number of startups may have peaked last year, as it looks like now the amount of startup funding has declined to its lowest levels since 2019, declining by about a quarter in the last 3 months to only $62.3 billion. And if Elon Musk is right, a lot of startups might not make it through the next downturn. So that's sort of sad for startups. And in sign number 8, with the global oil reserve volume being around $1.7 trillion, many of us have been dealing with high gasoline prices throughout 2022. And oil prices are actually a pretty significant sign of an upcoming recession because, as I talked about in a previous video, whenever oil prices have rapidly spiked, that actually tends to precede a recession. And it happened in 1990 and again in 2008. And it could be happening now because this year we saw prices per oil barrel reach a high of $130 per barrel. And now, as of early July, it's dipped below $100 per barrel. So that could be showing that as it's spiking, it's coming down, and it could be showing and reflecting a weakening economy. And also, we aren't quite having gasoline prices as high as it was in July 2008, when back then it reached a peak of $4.11 per gallon, because recently we only hit in June 2022 a high of $5.03 per gallon, and we would have to have gasoline prices hit about $5.58 per gallon to be as high of gasoline prices as we were back when the 2008 recession was underway. So we're not quite there and having peaked in our gasoline prices, but we're pretty much there. So we might as well be bracing for a recession as we speak. And in sign number 7, with U.S. corporate bonds of $10 trillion outstanding, there's this corporate bond market distress index, which is showing that we could be at comparable levels to back in August 2007, not nearly as bad as it was during the pandemic recession and the 2008-9 recession, but starting to creep up. So this is definitely a sign to watch. And I actually also talked about the level of corporate debt being a pretty significant recession sign as well in a previous video, so feel free to check that out. But I consider corporate debt to be a big deal because it's back at some of its highest levels it's ever been, if not the highest in history. So to me, this could be potentially a black swan that a lot of people are kind of taking for granted for now, but we'll just have to keep tabs on it. Sign number 6 is a combo of the $14.5 trillion of U.S. consumer spending and also $6.6 trillion of U.S. retail sales in 2021. And there are signs that consumer confidence is falling hard based on the University of Michigan's Consumer Sentiment Index, which reached its lowest level in its 70-year existence to a figure of 50 in June 2022. And also 79% of its survey respondents believe that there will be bad times and business conditions in the year ahead. So that's definitely not a good sign. And also with retail sales, that fell by 0.3% in May, according to the Commerce Department. So across the board, it looks like consumer spending is starting to slow down meaningfully. Sign number 5, with $30.5 trillion of U.S. government debt, is the ominous inverted yield curve, which reflects when U.S. government bonds' long-term interest rates fall below that of the short-term bonds interest rates, which is not what you would expect, because normally if you lend money longer, you expect a higher interest rate. So when these yields start inverting, that reflects bond investors' belief that an economic slowdown is ahead, and it's actually been one of the most reliable indicators of an upcoming recession going back decades. And it happened in 2019 before the pandemic recession, so it's still proven to have worked throughout many decades. And also commonly, the 3-month treasury bond compared to the 10-year treasury bond is thought to be the best indicator of this, but often the media cites the 2-year treasury bond compared to the 10-year treasury bond. So we're going to go with that one for the sake of explaining this example. And it happened a couple of times before July, on March 31 and June 13 briefly, but it didn't really stay there. But since July 6, it's been consistently staying an inverted yield curve between the 2-year and 10-year treasury bonds, where it's reached its biggest gap on July 11, where the 2-year treasury bond reached 3.07% and the 10-year treasury bond reached 2.99% for a gap of between 0.8%. So that's a pretty big deal, because if it keeps widening, that might be indicating that a recession really could be underway sooner than later. And sign number 4 is the U.S. stock market and using the $32 trillion market cap of the S&P 500, which has suffered its worst first half of the year since 1970. And it appears to have entered a bear market since mid-June 2022 because it's shed more than 20% of its market value since the high that it reached of $40 trillion in early January 2022. And at the time I'm recording this, the S&P 500 is off 1,000 points from its all-time high of 4,818 that it reached in early January. And also there could be more carnage ahead if Jeremy Grantham is correct in him sort of predicting that the S&P 500 could reach as low as 1,900. So there could be another 50% down perhaps. So who knows what will happen, but that's definitely something to probably keep tabs on, but not go too crazy over. And sign number 3, in the $33.6 trillion U.S. housing market, it looks like housing demand and new home construction is slowing, with interest rates going up to make mortgage rates hover above 5%. So that's definitely discouraging some new home buyers, and also home sales are slipping, and also some real estate companies like Redfin and Compass might be laying off workers in anticipation of a housing downturn. And also Zillow mostly got out of the house flipping business, maybe also expecting that housing is about to go down more. And sign number 2 is the $46 trillion of U.S. market debt outstanding, and this figure probably reflects all forms of US corporate debt, including bonds and loans, and also US government debt. So it's the whole enchilada of debt in the United States. So this is a pretty big figure, and I probably gave some of the lessons away regarding corporate debt earlier, but you get the point. And according to investor Howard Marks, the worst of loans are made in the best of times. So definitely brace yourself for what could be coming in the ugly space known as debt. And finally, in sign number 1 are inflation-related indicators, because high inflation erodes asset values and depresses economic activity. So it's all-encompassing, and there are a couple of inflation-related indicators that may not be super well understood and may not get the most airtime, but they're important because professional money managers are positioning their portfolios based on some of these indicators. So I think they're important to try to understand. And the 10-year break-even inflation rate reflects the difference between what investors could get in just getting the nominal bond rates of US Treasury bonds compared to the TIPS, which are the Treasury inflation protected securities. And that difference is the 10-year break-even inflation rate, which peaked at almost 3% in April 2022. And it's been going down, maybe in anticipation of depressed economic activity. So the fact that it's going down shows that investors are thinking that things are about to slow down. And the same thing with the 5-year forward inflation expectation rate, which shows what investors believe will be inflation in about 5 years and also compared to 10 years from now. And that's also slowing down after peaking at about 2.6% in April 2022. So I know that some of this may be a little bit confusing, but I hope that generally made sense. And I have it on good word of a 92-year-old friend of mine that the inflation we're seeing these days is worse than even the inflation of the 70s and 80s. So that's definitely something to keep in mind as well. And so those were my top 10 recession signs of a weakening US economy in 2022. And let me know in the comments what you thought and what's your favorite recession sign. I'd love to hear from you. And if you want to get prepared, I made this prepare for a recession checklist video that you can feel free to check out and see if it helps you. And also, if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be. Till next time.